The building is not moving. Why is the risk moving? Well, the climate science is developing, and we are finding new things all the time, and these models are changing all the time. And these tools are also developing themselves. So we know that climate change, physical risk from climate change, very widely split into two categories. So you have chronic events like sea level rise, and you have acute events like flooding or hurricanes and typhoons and so on. So in the short to medium term of let's say next 10 years, we're not going to see the sea level rise quite having that impact. Average temperatures are going to continue to rise, so the risk of overheating will happen. But I think the actual shorter term risks are your acute weather events. So when it comes to climate change, there is no place on Earth that is completely safe and no risk. You will have risk from wildfires from Australia to California. You have flooding risks in anywhere in Europe, UK, for example. You have risk from typhoons and all sorts of extreme weather events in Asia. So there's a risk everywhere. It's the question of which type it is and how to manage that. When it comes to asset types, all buildings are a point on the map. So it doesn't really depend that much on the building type and the asset use in real estate. Where the risks become more complex is actually infrastructure. It's not the risk type or the asset type, but the risk level. So if we feel that the risk is too high, or that it cannot be mitigated, so you can think about the physical risk. If the flooding is too high and we feel that the asset in that position will not be insurable, it's sort of exposed just to too much risk from flooding, we are not going to be investing there. It could be that the asset needs so much improvement in order to achieve a certain standard of energy and carbon performance that the business plan doesn't stack up. Well, actually, it's not only the risk; it's also an opportunity. You can add value to the assets when you reposition them or refurbish them. We have a couple of actually excellent examples of the historic buildings, which are actually listed buildings. Where we have really stripped them down to as far as we could, preserving all the historic value, and reinstalled new and modern technologies, the state of the art, where these assets now have much better rental incomes and also much better valuations. So what will happen is that we will not see insurance companies being willing to insure assets that are at too high a risk, or lenders or banks being willing to lend. If you're trying to refinance an asset, or if you're trying to insure an asset, if you're trying to sell an asset, the counterparty is going to be doing exactly the same exercise. They'll be looking at the risk levels and what mitigation measures are in place and whether they want to enter that level of risk. Definitely think about long term, especially if you're intending to hold this asset long term. But even the medium term, let's say you're buying an asset with a risk, and you think, well, okay, this flooding is going to happen once in 100 years. It won't happen in 20 years or 10 years that I'm going to hold it, and then I'm going to sell it off. Be aware that the point when you're trying to sell off the asset, the potential, the liquidity of the asset is going to be heavily impacted by the risks the asset has, even if they haven't played out yet. And of course, I mentioned already insurance, or if you want to borrow money against that asset, you're going to also face the same challenges. So don't say, well, this is once in 1,000 years event, it's not going to happen, and it hasn't happened, so I'm going to ignore this.